Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. And our first question today is from Alan, and Alan asks, I follow Warren Buffett, and Warren Buffett's advice is I should invest in index funds because of the low fee. Is that a good idea? All right, Alan, let's explore Warren Buffett's perspective on index funds and how it relates to your retirement income strategy, focusing on reduced risk and volatility. Low fees are indeed a key reason Warren Buffett favors index funds. However, it's crucial to consider your own financial situation compared to Buffett's. As a billionaire, Buffett can afford to live off very low yields like those from the S&P 500 index fund, which currently yields maybe 1%. Right? For most of us, especially in retirement, relying solely on such low yields might not provide sufficient income. Index funds typically yield around 0.5% or less, which may not meet your income needs in retirement. Another reason Buffett prefers index funds over actively managed mutual funds is due to the influences and costs associated with the latter. Actively managed mutual funds often have higher fees and can be subject to buying and selling stocks at prices that may not be optimal due to their size and trading volume. Now, this can result in lower selling prices and higher buying prices compared to an individual investor managing a diversified portfolio of stocks. However, Buffett himself primarily insists he insists on owning individual stocks rather than index funds because it allows him greater control over his investments and avoids the influences of fund management. Right? This approach not only reduces costs, but can also potentially enhance returns, particularly in terms of income generation and managing market volatility. So Alan, while index funds have their advantages, particularly in terms of low fees and broad market exposure, they may not be the best solution for maximizing retirement income or managing risk effectively. As you approach retirement, it could be beneficial to consider a diversified portfolio that includes individual stocks or other income-generating assets tailored to your specific financial goals and risk tolerance. By carefully assessing your options and understanding the implications of different investment strategies, you can better align your portfolio with your long-term financial objectives. Alan, it's a great question. It's an important topic. And many of our viewers can benefit from understanding it in depth. Good question. If you would like to send in your question, like Alan did, you can do so. You can email it to poollocke@poollocke.com. Moving on to our second question from Jerry. He asks, what do you think about municipal bonds? My mom invested in those, which I understand are tax-free. So do you think they're a good investment? All right, Jerry, let's dive deeper into municipal bonds as an option for generating income in retirement, focusing on reduced risk and volatility. So, municipal bonds can indeed be a good investment, particularly for those seeking tax-free income. Now, traditionally, they've been popular among retirees due to their tax-exempt status at the federal level and often at the state and local levels as well. However, there are several factors to consider before deciding if they're right for you. First, the tax benefits of municipal bonds are most advantageous for individuals in very high tax brackets. So if you're up in the top tax bracket, the tax-exempt feature allows you to keep more of your investment income compared to taxable investments. For instance, if a municipal bond offers a 4% tax-free yield, that's equivalent to a higher yield on a taxable bond, depending on your tax bracket. Second, it's crucial to assess the financial health of the municipalities issuing these bonds. Very important. not all municipal bonds are created equal, and some municipalities may face financial challenges which could increase the risk of default. Now, while historically, they're considered safer than, say, corporate bonds, recent economic pressures have shown that not all municipals are immune to financial distress. Therefore, when considering municipal bonds for your retirement portfolio, focus on high-quality investment-grade bonds issued by states or municipalities with strong financial standings. Now, general obligation bonds issued by states backed by their taxing authority are typically considered safer than bonds issued for specific projects or by local governments with more limited kind of revenue sources. Ultimately, the decision to invest in municipal bonds should align with your tax situation, risk tolerance, and income needs in retirement. They can be a valuable part of a diversified portfolio designed to generate stable income while managing risk. However, it's essential to conduct thorough research or consult with a financial advisor to ensure you're selecting bonds that fit your financial goals and risk tolerance. Very great question. It's important to weigh the pros and cons carefully when evaluating any investment, municipal bonds included, right? Especially when planning for retirement income. Thanks for the awesome questions. If you would like to send in your question, you can do so. You can email them to us at poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.